Peer-to-peer lending platforms, alternative investment opportunities and risks. The rise of peer-to-peer lending platforms has transformed the way individuals and businesses access loans and invest in debt markets. These platforms connect borrowers seeking loans with investors looking for alternative investment opportunities, bypassing traditional financial institutions. This article will explore the mechanics of P2P lending platforms, the benefits and risks associated with investing in these platforms, and the future of this emerging industry. The mechanics of peer-to-peer lending platforms. A. Connecting borrowers and investors. P2P lending platforms serve as intermediaries, connecting borrowers with investors who are willing to fund their loans. These platforms use advanced technology and data analysis tools to assess the creditworthiness of borrowers and assign interest rates accordingly. Investors can then choose which loans to fund based on their risk appetite and desired returns. B. Diversification and risk management. Investors on P2P lending platforms typically diversify their investments by funding multiple loans, thereby spreading their risk across a portfolio of borrowers. The platforms also offer various risk management tools, such as automated investment features and secondary markets for trading loan parts, allowing investors to manage their exposure and liquidity more effectively. 2. The benefits of investing in peer-to-peer lending. A. Attractive returns. P2P lending platforms offer attractive returns compared to traditional fixed-income investments, such as bonds and savings accounts. Investors can potentially earn higher interest rates by funding loans to borrowers with varying credit profiles. B. Diversification and portfolio enhancement. Investing in P2P loans provides investors with an opportunity to diversify their portfolios and gain exposure to an alternative asset class. This can help improve overall portfolio performance and reduce volatility, especially during times of economic uncertainty. C. Supporting small businesses and individuals. P2P lending platforms enable investors to directly support small businesses and individuals in need of financing. By investing in loans on these platforms, investors can contribute to economic growth and job creation at a grassroots level. 3. The risks of investing in peer-to-peer lending. A. Credit risk. The primary risk associated with P2P lending is credit risk, as borrowers may default on their loans. While platforms conduct thorough credit assessments, there is always the possibility that a borrower will not be able to meet their repayment obligations, resulting in a loss for the investor. B. Platform risk. Investors also face platform risk, as the P2P lending platform itself could face operational, regulatory, or financial difficulties that could impact its ability to facilitate loans and protect investor funds. It's essential to choose a reputable platform with a solid track record and robust risk management practices. C. Liquidity risk. P2P loans are generally not as liquid as other types of investments, such as stocks or bonds. While some platforms offer secondary markets for trading loans, the liquidity of these markets can be limited, making it more challenging to sell loans quickly and at a fair price. 4. The future of peer-to-peer lending platforms. Regulatory developments. As the P2P lending industry continues to grow, regulators worldwide are developing new frameworks to ensure the stability and security of these platforms. Investors should stay informed about regulatory changes that could impact their investments and the overall P2P lending landscape. B. Technological innovations. Technological advancements, such as artificial intelligence and machine learning, are expected to play a significant role in the future of P2P lending. These technologies can enhance credit assessments, risk management, and the overall efficiency of the lending process, benefiting both investors and borrowers. C. Increased institutional involvement. Institutional investors, such as hedge funds, pension funds, and insurance companies, are increasingly recognizing the potential of P2P lending as an alternative investment opportunity. As these institutional players enter the market, the industry could experience greater liquidity, stability, and growth. Navigating the world of peer-to-peer lending. Peer-to-peer lending platforms offer unique investment opportunities and the potential for attractive returns. However, investors must carefully consider the risks associated with P2P lending, such as credit risk, platform risk, and liquidity risk. By conducting thorough due diligence, diversifying investments, and staying informed about industry developments, investors can maximize the benefits of P2P lending while mitigating potential risks. The future of P2P lending is promising, with technological innovations and increased institutional involvement expected to drive further growth and improvements in the industry. As the P2P lending landscape evolves, it will continue to offer new opportunities for investors seeking alternative investment avenues and borrowers in need of financing.